Hour. Coming to you live, I'm Gav Blacksburg, CEO at Wolf Financial, here with Evan from Stock Market News, and of course, Adam Patty from Vista Shares. Adam, super excited to have you back for another conversation. Our last one was at a really interesting time when Elon Musk and Donald Trump were feuding and fighting, and we talked about buying the dip on that and some opportunities, and that's worked out really, really well. And we also talked a lot about ETFs. How's everything going by you today?
Everything's going great. It's great to be on the Power Hour.
Yes. Power Hour wrapping up the week here, 3 p.m. Eastern. And it was a big week, especially when we look at the series of ETFs that we're going to be talking about today. So just for those initially joining, 2 ETFs we're going to start with OMAH, that is Omaha and QUSA. And then later on, we're going to talk about AIS and WILD. We're going to kick things off, though, on this dividend, income side of things, which has been really rolling. This seems to have gained the most traction within your portfolio, OMAH. And there's also distributions that are happening right now. And there's become this retail phenomenon around these distributions. You see, when you put out the post, right, people are just getting into those comments. What do you think makes these so attractive for people?
You know what? I think today's investors, retail investors, are just a lot smarter than they were when I was, that age, in my 20s. When I was in my 20s, I was looking to, trying to find a stock that would double or triple. Now investors seem, more interested in building up their nest egg for the future, and particularly using these dividend or income strategies where they can stack their dividends and get paid, every day of the week, and one day retire based on that income stream. So it's a whole different mindset, and it's just very interesting and quite very smart on their part.
100%. It has rewired people's mindsets a little bit. So we can take a look right here. This is for OMA and QUSA. And right here, you can see the distributions currently include return on capital, OMA 100%, QSA 100%. Can you just walk people through what this all means that they're reading here for those that maybe are unfamiliar with these type of ETFs when they see an ex-div date, a pay date, the distribution per share, all those pieces?
Yeah, so today is declaration day for both of our ETFs, OMAH and QUSA. And what that means is today we're declaring how much we're paying this month. These are monthly payers. So both of them have the same exact income strategy. We're targeting 15% annually, and we're paying that monthly. So we target 1.25% per month. And that's exactly, again, what they're paying out. So today's declaration day, it's the last day of the month for somebody to get in and get that income for the month. Ex-dividend date is on Monday, where then that's where the ETF starts trading ex-dividend. So the dividend amount will come out of the share price. And then pay date is on Tuesday. And I want to mention that, Tuesday seems to be a really interesting day to pay out. In fact, just to, give you a sense of how we work with the retail community, we had a payday of Friday when we first brought out OMAH, and everyone came to me and said, it'd be really amazing if you can make your pay dates on Tuesday. There are no other ETFs that are paying on Tuesday. This way, people like to get paid every single day. So I changed all the paydays on our income strategies to pay out on a Tuesday.
Nice. Yeah, I can see Mike highlighted that inside of here for the pay date next week, Tuesday, 6/24. And right now, again, you're hitting at that 1.25%, correct? That's the monthly target. That'll lead up to the 15% annually. I always like to just cover this for those that are not fully understanding. So people look at this and they say, all right, am I just getting, capital back? Is it being paid out? Does that mean that the ETF is going to drop by that amount, right? Maybe you can explain a little bit for those who are just not so knowledgeable in this area.
Yeah, and it really depends on the product, right? There are those ETFs out there that are paying those nosebleed returns, 100% payout a year or 50% payout. Then there are products like ours, which are portfolio tools, right? These are core portfolio holdings. And these type of products pay out anywhere between 8 and we're at the top end at 15. So, what we do with this is very simple. We have, and I could talk about the portfolios after this, but in terms of the income generation, clearly you're getting dividend income on the types of companies that we have in our portfolios. However, that doesn't go into our calculation. Any dividends being paid by the underlying securities is actually reinvested in the NAV. So that helps with what people get afraid of called NAV erosion. But the NAV erosion phenomenon is not as pronounced when you're only paying out 15%. It's really when you're paying that 100% out that you could see that kind of over time where the NAV is going down. So yeah, I mean we run an active options overlay and on all of the underlying securities. So OMAH has 21 securities, QUSA has 27 securities, and we run these. We sell out of the money calls on these securities, and our goal is very different again than others. Also, we're not looking to maximize income. We're looking to generate 125, not 126, not 127, 125. So if we happen to generate more than that on a monthly basis, we roll that back into the NAV as well. So we're not, it's a different strategy. This is a consistent, steady Eddie earner. That's what we position it as. It's not looking to shoot the lights out and kill it for you on a certain month. That's not what we're doing. So we think that's a little bit of a differentiator as well. So it's an option strategy. We also use call spreads, which is particularly important in volatile markets. I don't know that there's any other ETFs in the market using call spreads as well. I think we're the first and only, but it's really good in volatile markets. So we're trying to. So the goal of the product is one, generate that 15%. And it's right in our name, target 15. We better generate that 15. And then our secondary goal is capital appreciation. So, any type of options overlay strategy will never keep up in a booming bull market with the same portfolio without the options. The options are a drag on performance because you're getting that in your total return in the form of income. So I always tell people expect 70 to 75% of the upside from a total return perspective and 85, 90% on the downside versus the same portfolio without the options.
Got it. Yeah, it's definitely really interesting. One more clarifying question within there. So I just want for people that are going and looking right now, right? You're watching the stream, which by the way, about 3,000 people already. Love to see it. Welcome in on a Friday afternoon, educating yourself, investing in yourself. This is the way to do it. They're going to go look at OMAH and they're going to say, all right, this thing was launched in March 5th. Right now, the chart says down 3.81% this year, but that doesn't tell the full story, right? With there being percent, price return with these other pieces. So how should they, from a holistic perspective, look at the actual return this year?
Yeah, so it's the price return plus the income that you're getting. So, we launched right before the tariff tantrums hit. So, everything was coming down. So, it wasn't great timing from a launch perspective. So QUSA, of course, launched after that. So, you'll see the NAV a little bit higher. But so you're looking at the price return, and then you're adding in the income. So this is our fourth month paying 125. So it's 5% on top of that you would have gotten if you had held it from the time we launched. I think the NAV price when we launched was a little bit under 20. It was like 1980 or something like that. So now we're down to 1917 today. So so that's the price differential right there. But then again, you're adding in the income that you've generated. So the performance has been actually quite good if you compare it to the S&P as well as even Berkshire B.
So they could look at that time period and say it's really up a little bit over 1%.
Yes, exactly.
There you go. And that's what I wanted to highlight for people, for them to understand, is that I think a lot of investors, retail investors who are not familiar with this area are familiar with just looking at the chart, and they don't factor in the income portion side of things. It just doesn't go in their mind.
That makes sense.
Outline it.
Yeah, and that totally makes sense because you don't see it on the charts, right? You got to look at the total return. Total return is price return plus income. So charts only show you the price.
Yeah, this is really helpful, I think, for people to continue to keep in mind. Evan, good to have you on here with us. You've been, just like me, learning a lot more about these types of ETFs within the past year. Curious if you have any thoughts or questions here.
Yeah, one first thing that I find interesting is that on OMAH, on the Buffett one, Berkshire Hathaway, obviously Warren Buffett's a really popular name, and there's been a lot more of these single stock ETFs taking different formats coming up, but none have really capitalized on the Buffett name, Berkshire Hathaway. So I find it really interesting that you were kind of able to find a way on a name that obviously we all know and people will gravitate towards of able to capitalize on it. And I really don't think it's a coincidence that there's the AUM behind it. So I think you sparked something there. I wonder if there's other ways you can kind of take that idea and go to it. I've always thought like, hey, could we ever 2x leverage these really kind of boring, really popular names like a Berkshire Hathaway? I don't know, Walmart, or whatever random names it is. But I thought it was really interesting seeing you guys able to play off that Buffett name in a successful way, which I haven't really seen.
I appreciate that. And look, I mean, I wish I can take all the credit for it, but it's really came from investors. I mean, every single product we launch, there's a lot of research that goes into developing that product. So when we went out and talked to investors saying, VistaShares wants to develop some unique income strategies, what is missing from your toolbox to make your portfolio outcomes better? And two things really came up a lot. One was, I love Berkshire Hathaway, but it doesn't pay a dividend. So I said, okay, well, that's interesting. And from there, what we did is we said, well, we don't want to just have Berkshire Hathaway in the portfolio. Let's dig into what Berkshire Hathaway holds, and let's have a well-diversified portfolio of stocks in that portfolio. So our portfolio in Omaha is Berkshire B, plus the 20 largest publicly traded holdings of Berkshire Hathaway. So Apple and, Visa and VeriSign and Kroger and Coca-Cola, all the names that Warren likes. And the other thing that we kept hearing is, we like factor tilts. Factors meaning just, a fancy way of saying financial metrics to identify certain attributes around companies. So, quality, value, momentum, low volatility. So that's QUSA. QUSA is a quality portfolio, meaning we use financial metrics to identify those companies with the highest levels of, quote, quality, meaning high profitability, low debt, and stable earnings growth over time. And that's how we score them. And that portfolio is 27 equities. And it looks very different than OMAH. And it looks very different than most portfolios most investors probably invest in.
Okay. I have a question real quick within this. It's actually not a question. It's more of I want to show people something, because I think that you've actually had optimal conditions here for this launch. And this is probably why OMAH is getting so much traction. If people go ahead and they take a look right now, and I'm just going to pull up the chart on Berkshire Hathaway, which has really been declining, I think, more than people would have thought in the recent weeks. So we're looking back to March 6th here, which was the date that this launched for Omaha. And obviously, Berkshire had quite a run from there, right? They at one point were up about 9%. But when you look at it over the full move, it's actually down 2.8% at the moment. Now, coming into a great spot right here where you have a trailing 200 SMA and trailing 200 EMA. And this is like perfect. I mean, Buffett has just such a track record of bouncing right here. So if anybody is looking at Berkshire, keep your eyes out. Look there, right? So I really wouldn't be surprised if we see this as a bounce right here. But when I go ahead and I pull up Omaha during that same time period, well, I don't even have to pull it up. We just talked about it. In that same time period, Omaha, while it'll show, on the chart down 3.8, right? It's actually has that 5% of income. So it's up about 1% right there. And so your outperformance is almost 4% right now. Mm-hmm. Outperformance while still having exposure to majority of that underlying stock, right? And so this is kind of honestly ideal market conditions to show off the power of these products.
I agree. And look, that goes to single stock risk. I mean, again, very similar holdings. However, if there's a negative narrative around a certain stock, I mean, Warren Buffett retiring, Greg Abel coming in, maybe you took the wind out of Dirk Burke sales for a little while. But at the end of the day, it still holds Apple and Bank of America and American Express, and Kroger was killing it earlier today, I think it was. I mean, so, those stocks all move differently. So we have those in our portfolio. So we're getting rid of that single stock risk of just buying Berkshire B. Now, of course, if you own Berkshire B, I mean, plenty of people do, you could also own OMAH as a complement to generate kind of like a synthetic dividend off your Berkshire exposure. And that's the other thing I kept hearing from investors and why we brought this product to market.
Do a lot of people just roll these distributions back into the ETF?
Yes, they do. And that's another interesting phenomenon. So again, hat off to the investors, the retail centric investors. They're building their nest egg. So they're looking for the income. They roll it back in to buy more shares, which gives them more income the next month. Boom, they keep doing it. They're stacking it. And it's really interesting. And it's, as you mentioned, it's a phenomenon and it's new. This is a thing that's been probably going on for, I mean, look, people have been investing in dividend stocks for, a long, long time. But in terms of this kind of this strategy that so many people are following, and rightly so, it's really probably a couple years old and it's gaining more steam. So
Right.
it's really important to, I think, get ahead of that from a product provider.
What's the downside here? To me, it seems like there's two possibilities. One, Berkshire Hathaway, the underlying stock, just absolutely rockets to the upside, and you miss out on that move because you're being capped by the calls. And then two, something goes horribly wrong with the call selling strategy and destroys part of the ETF. Maybe you can kind of walk through those pieces.
Yeah, I mean, again, Berkshire B, if it rockets to the upside, we're not going to keep up. Unless, of course, the underlying securities in our portfolio, because again, we're holding 21,
Right.
not just Berk B. Berk B is our largest holding, or at least at rebalance, it's largest holding. I think Apple now is our largest holding. And Apple has not performed well. So that has been a drag on our performance. Now,
Not at all.
when that turns, that's going to impact us well. But yeah, I mean, we're not going to keep up in a big bull market ever. That's just what it is. We're going to do best in kind of sideways markets, or a little bit up, a little bit down. But yeah, I mean, look, we looked at this strategy over many years to see if the calls are whether it's sustainable, and the types of companies in these portfolios have very robust options markets. So yeah, in theory, if there's something horrible happens in the market and the whole options market dries up, yeah, we're going to have a big problem generating that income. There's just no doubt of it. And so will everybody else, anyone doing these types of strategies. Because if you can't get liquidity on Coca-Cola or American Express, I mean, there's bigger problems in the market for sure.
Let's talk Apple for a second here, because it is the drag, but it seems like it could come back. Let's take a look for a second at the Apple chart since we're talking about it. Evan, is Apple still your largest holding?
Like individual stock, yeah. But I own like a lot more of different ETFs.
He's a QQQ man. All right, so Apple I think looks really interesting here as well. We're obviously way below. We actually have a descending 200 SMA and EMA now, which makes it look interesting. You can see I'm just doing some daily technical analysis here.
One thing I will also say, if Nvidia and Meta keep going up, there will come a point not in the too distant future where they would pass the Apple shares too. I'm looking at it now.
Yeah, I don't think this is a bad spot for Apple. So you can see TrendSpider highlights a value area high and low for me, just utilizing the data from the past year. And we had this huge drop through the bottom of the value area low, but it's come back up and it's sitting right here. And this is a great spot because you also had multiple peaks right here. So you just have a ton of volume sitting on this shelf. Adam, how closely do you watch Apple as an individual stock? And what's your thoughts on it this year?
Yeah, I mean, I'm no expert, probably like you guys are, but I do follow it. I do own it in my own personal portfolio as well. I think Apple is just disappointed investors around the AI trade. I mean, I think at the end of the day, I think people are starting to view it as kind of an old school company, which I think is silly. I think it's a narrative driven trade right now on Apple, that it's just out of favor, and they'll have a couple of good announcements and it's going roaring back. I don't see anything in the fundamentals that have actually changed over the last 6 months.
Evan, are you in the same boat?
Yeah. Well, here's the thing. Mostly, yes. I think that there's a lot of questions you got to ask yourself about their AI rollout. But the important thing is the next device that someone's going to go and buy still going to be an Apple product? Is the probably next two devices that they're going to go and buy at this point still probably going to be an Apple product? I think the answer is still yes. So that's kind of the things that I'm looking at here. And any good AI announcement will start to get us back up to that 250 range. Now, what happens in the future, we'll see. They obviously do have to start innovating again. And hopefully the Vision Pro is what that starts to become.
Uh-huh.
But yeah, I think that it's, a lot of the criticism they're getting is very justified. But I still definitely think there's some opportunity there. There are ones like I get a lot more excited about Meta at this point in time than an Apple.
Well, Meta certainly seems to be a lot more aggressive on the AI front for sure, at least in terms of their public announcements.
I think that, when you're talking about CEOs and everyone's like criticism of Tim Cook is, hey, he's like a great like manager, but maybe not a great innovator. And are we in a time when there's aggressive amounts of innovation going on? So I hear the arguments. Maybe, hey, Tim Cook isn't great. Maybe it's like, hey, take a 5-year hiatus and come back. We'll need you again. I don't know, but I don't go that too far. Any moment in time, if this really is a really big innovative thing, if AI is going to come in and change everything, that means we're in the first inning. And I wouldn't count them out.
I agree.
Yeah, Tim Cook's a great operator, former COO for Apple, and I think he does awesome in that area. Somebody posted the other day and they said, how would Steve Jobs have dealt with the tariff situation? And they said he would have gone into the design lab with, Ives, and they would have left it to Tim Cook to handle. And it's like, yeah, that's exactly what would have happened, right? Because he would run the ops. It's just the side of, building new products and creativity and AI and things like that. That's a little bit of a different area.
Yeah.
So still a great leader, but maybe just needs some help.
Yeah, and I certainly wouldn't count him out. I mean, look what happened with the iPhone, right? They were late to the market. Of course, that was Steve Jobs and driving that. So to your earlier point, but I think there's a lot of it. I think the DNA of Apple is all about innovation. So I think they'll be around for quite a while and doing. Look at Microsoft 15 years ago, right? I mean, Microsoft was counted out.
Steve Ballmer.
Yeah.
Let it through the lows.
Yeah, exactly.
Look at him now. He's got the wall.
Oh,
so,
I love it. So yeah.
Very fun. Question for you: how much data do you get on who's trading these shares of OMA? We're seeing 1 million shares traded a day.
You know what? The nature of the ETF is that you don't really know who's trading it, in terms of unless they're filing a 13F.
Right.
So, and that's delayed a quarter, right? So unless you can't know. I mean, it's frustrating, and it's just the way it is.
Yeah. What were your expectations for, 3 months in, how many shares would be traded daily?
I would hope for 50,000.
Yeah. Wow. And now 1 million. Yeah.
Yeah. I mean, this product is just absolutely just rocketed. It's, I've been in the ETF market since 2001. I built the company, we built it up to $5 billion in assets that I sold to New York Life. We never had a product that traded 1 million shares a day. Our biggest product was probably about $1.5 billion in assets. And I think we were trading about 50,000 shares a day, even then.
Yeah. Pretty crazy. So showing it on the screen here for those who want to go check it out. OMAH target 15. Yeah.
I would be very curious to hear who's buying it, but I really think it's that Buffett thing. And like, hey, if I'm a financial advisor and I think this new brand of income ETFs is really great, you can try and pitch them on different areas, but pitching them, hey, it tracks the Warren Buffett largest holdings. I think the strategy is interesting. Let's try it out. I wonder if that's something that's happening here.
The pitch is invest like Buffett, but with income.
Yeah.
Couldn't be simple.
I really wish we got some of that data, obviously, but I don't know if everyone besides us goes and it cares about it as much.
There is a lot of retail trading. I'll tell you that. I could tell by the trade sizes. You could tell when an RIA is or a family office is putting a trade in, because either it's a massive trade or it's a series of trades that, 100 trades that'll be time stamped at the same exact time. And then you can see kind of what a retail trade looks like. So you could see, but I don't have any data to support, a percent breakdown.
Yeah. I'll just share this real quick. This is still up to date, right? Does this need to get edited?
Does it have today's district? Yeah, I can't see, but yeah, it looks right. There's an amount there, right? For today,
yeah.
620. Yep.
Yeah, 620. Perfect. Okay. Yeah. So this is updated for everyone that wants to take a look. Declaration dates, ex-div dates. It's all on the website. Let's take a look at the other ETF here, QUSA, which is in a similar vein on the income side, but very different in regards to the actual underlying strategy and what it's holding. If people do scroll down, they can see the actual top 10 holdings. And obviously on the, OMA one, there's Berkshire and then a bunch of Berkshire related names. This is a bunch of very different names from that. Could you walk through explaining the holdings and characteristics here?
Yeah, and it's interesting that Oracle's in the top 10. Oracle's been on a tear, so it was not in our top 10 a week and a half ago. But it just rocketed up the league table. But again, this is all about factor investing. This is about taking a core equity portfolio and tilting it to something that you think is going to be more attractive moving forward. So, we were in a kind of momentum-driven market for many years, and now we're in kind of a value and quality tilted market. So value, certainly OMAH is more value tilted, and this is quality tilted. And what that means is, again, what quality means is it's very simple. It's a series of financial metrics that are used to score companies. So, we look at companies that are highly profitable, have low debt, and have stable earnings growth. So what we do is we take the Russell 1000 and then we score them all based on those metrics. And there's multiple metrics within each. So profitability is ROE and ROA. We look at market value of debt, and we look at multiple metrics within each one of those categories: profitability, debt, and stable earnings growth. And we score the Russell 1000. So what this is we take the highest scoring companies within the Russell 1000. So mostly large cap, but there are some mid caps in here as well. And in this case, we have 27 of them, and we rebalance the portfolio quarterly. So it's a very interesting portfolio made up of companies that are ideally suited for today's environment. And then, of course, just like OMAH, we put the same 15% target income strategy on top of it, paid monthly 1.25%.
So right now, let's do the same thing for this one so that people can have an understanding. Right now, if people go to the chart, this shows that it is slightly green, up 0.3%. It actually was having a real rip of a start up until May 19th, and then it's been coming back down with some of the names that are inside of here. But as you're mentioning, at this point, there have been, is it one payment or two payments?
We just paid our second payment was declared today.
Declared today. Okay. So that's going to be two payments of 1.25. So
Correct.
you're going to have a 2.5% right there. And so this in reality is not up 0.3%, but people who have been invested in it, they have a return on investment of 2.8%, correct?
Correct.
There you go. So this is just a way to think about it. And in that time, and so that's since May 6th. And I'm curious if we just look at, what do you think people might have in their portfolio right now that they're substituting something along these lines for?
Well, a lot of people use, there's an iShares ETF, QUAL, which is like the big quality ETF out there. People use that. But I think typically most investors are, using, the S&P 500, right? And just letting it roll.
Got it. Yeah, when they look at the S&P 500, it has been on a bit of a roll the last month and a half, especially. I think it's up like 6% in that time frame. How do you kind of talk to people who are like, hey, like I understand that you're looking at this and it's up 6%, but here's why there's value in this area?
Yeah, I mean, look, the S&P 500, which most people, your listeners probably know, but many investors don't know, is that it's, extremely heavily weighted to Mag 7 type stocks.
Yeah.
So, which is scary from a concentration risk perspective, because I'm sure most investors already own those securities in other funds or as a single stock. So yeah, look, when the Mag 7 is on a tear, the S&P is going to go on a tear. But, if there's a hiccup in that, in the big tech market, it's not going to perform as well. Again, what a quality tilt is for is a complement to a core equity portfolio. So I'm not saying you get rid of S&P 500 exposure. You want to keep that as a core exposure, but you want to use something like this to tilt your exposure in your portfolio to something with, that kind of protects on the downside, perhaps in some markets, and in some markets should outperform while getting that 15% income along the way.
Beautiful. Evan, curious your thoughts here on QUSA. What sticks out to you when you're looking at it?
Yeah, no, the quality part of it is definitely a very interesting one. I haven't looked at the AUM on this one. How is it picked up?
We're about at 11 million right now. So it's it's a much newer fund. It's about a month and a half old, or almost 2 months old. So it's growing actually on the same trajectory as OMAH. OMAH for the first couple months kind of got up to about 10, 15 million in assets. And all of a sudden on the third distribution, it took off. I think investors want to see that it works from an income perspective, which makes sense.
There's a couple names in here that I definitely do find interesting. The CME group. We've kind of had the talks about, it's gone through like sports betting of, not wanting to own the sports betting, but owning the data providers, and, not necessarily wanting to own a broker, but owning the exchanges themselves, which has been an interesting conversation as well. And obviously Microsoft has been hitting all-time highs, but it doesn't feel like it's one of those ones that goes up very, very, very aggressively. It's more a little bit of slow decay up to the top. Although if you look a couple months ago, it's probably doing negative. So there's some very interesting names in here. I feel like a couple that people wouldn't even know as well, like in Illinois Toolworks, which I like to look at the 52-week high list a lot, and that one's been on there a bunch. But I don't know. Same thing with APH actually, ADP too. A lot of these names are on there, so I see why they're in the quality bucket.
Yeah, and it makes sense, right? I mean, and that's why you want to use it because, as an investor, you want to have good diversification across your portfolio. So, what this product and OMH are designed to do is give you a little more diversification in your equity bucket, right? You don't need more Mag 7. You need more Illinois Toolworks that you have never even heard of and don't even own unless it's a very small holding within another index fund you own.
Yeah, the industrials and financials making up like 60%, 55% of this is also an interesting one. I'm curious on like when you filter out for quality, if you have any thoughts of like industrials, having a very heavy lean into it, financials too, or maybe not as much in some other area, and some more of like the broad-based market indexes. I do find that to be intriguing.
Yeah, I mean, we're not designing towards a specific sector allocation. It's really the way it's fallen in place. So that could change on a quarterly or a yearly basis. But every time we rebalance, the positions will change, which will change the kind of the industry and sector allocations.
The names definitely stay interesting, like he's saying. And again, it's similar to what we talked about with OMA. So people should remember that, right? In regards to the calls being sold on this and how if these are all rocking to the upside, that can actually cap the upside a little bit. And these do better, like you were saying, in that slower moving market, slightly up, slightly down, moving to the side. That's where this is going to really operate best.
Absolutely. And just one more point to your other point about how you use it. I mean, people are very familiar with value tilts, right? The value, and that's just one of the factors, right? So everyone is more familiar with value. You would use it just like that, right? So, or a growth fund or a value fund. It's a similar thing, except these are different financial metrics that are identifying different companies based on those metrics. The quality tilt is a little bit different.
Absolutely. All right, I want to rotate into these other two, and they've both been very interesting lately. Do you want to roll into AIS or into Wild?
Well, let's talk a little AI. I love talking AI.
Absolutely. So AI has still been running. I believe that this is your best performing fund so far at the moment.
Oh yeah, it's
Just if people want to go look at pure performance. And again, this fund AIS is not going to have the call strategy run on it. This is rather just a really high quality AI ETF using the picks and shovels plays. This is being put together by John McNeil and Sunny Madra. That's the former president of Tesla, as well as Sunny Madra, who is running Grok, not to be confused with GROK. It's GROQ, which is a very high quality AI company at the moment as well. This is up almost 10% year to date, and 8% of that has come just in the past month alone. And if you go back to, I guess, December, it's up a little bit over 5% all time. It's outperforming SPY on, I believe, pretty much every time frame. And it's got some interesting holdings inside of it that I'd love to dive into with you. But first off, just high level, what are you seeing in this world of AI picks and shovels plays right now? Where do you think we are in the cycle?
I think we're in the first inning. I think AI is a very exciting space to be in. I think every investor needs exposure to AI in some way. The key is, how do you get that exposure? And what bothered John and Sunny and the team with myself in building out the strategy is, when people are saying, I'm going to get some AI exposure, they're buying a fund that is primarily Mag 7 again. And, just like they have in the S&P 500, they're buying it again in an AI fund. And the thing is that to recognize is that these Mag 7 companies, I mean, putting aside, an NVIDIA type company, but these are not AI companies. They are the ones investing in the infrastructure to develop AI applications that one day will make them a lot of money. But, AI companies, the play in AI right now is in the infrastructure, and AIS is designed to give exposure to that infrastructure play. It's the only ETF that's doing it in the marketplace. And that's how we designed it, because John, and the reason why he wanted to get into ETFs in the first place, he was asked in an interview, how do I get access to AI? And he said, there's got to be an ETF for that. And he went back and looked at all the ETFs and said, wait a minute, there isn't, so we came up with this process to dig into the supply chain to really analyze all the different components of what goes into building an AI data center, what goes into building an AI semiconductor. And then once you have that supply chain all built out, then it's about determining what the bill of materials looks like. So if you know all the components that go into an AI data center, how much does each one cost? Because then you know how important it is to the build. And then you have to find the companies, and you got to look into their financials and determine, are these really AI companies? And that's how we build our portfolio. So, again, similar to our other portfolios that we just talked about, this is going to be a bunch of companies that most investors don't own. And we think that's important.
Yeah. Do you think it's funny, just a thought that came to mind when Evan was saying, hey, maybe this, OMA really caught traction because you had that Warren Buffett, Berkshire name in there, right? And people are gravitating towards it. Maybe we have to, adjust on AIS and call it, former president of Tesla AI ETF.
Exactly.
We can pull some of that.
Yeah, that would be great. Great. We can use his likeness on all the advertising. He would do it. He'd love to do it. So
yeah,
and that's the key. So this product, to your point, was designed by AI experts. This wasn't a bunch of Wall Street analysts in a room saying, let's build a product. No, this was experts saying, how do I get AI exposure?
Yeah, let's roll through it a little bit. People can see here on the website, again, vistashares.com/ETF/AIS, all the different pieces here in regards to, why they're going with these specific names, what the investment process looks like, how to invest. And then as you come down here, you're going to see the actual holdings. This SK Hynix always seems to rise to the top for you guys.
Performance has been out of control. I mean, that's a really strong company. I mean, it's been doing really well. So, but again, most people probably don't own it. Taiwan Semiconductor people probably know more about, or Micron. Most people probably don't own Vertiv. Vertiv is the largest provider of cooling systems for AI data centers.
Right.
Incredible company. GE Vernova is one of the companies we just recently added to the portfolio because this is an active fund. We added GE Vernova because they're the largest provider of turbines for generators that are now being built on the campuses of AI data centers, so they have enough power to run the data center.
Can I ask real quick, because this is a bit unique with SK Hynix, right? A lot of these, I think people are very familiar with these, MU, TSM. This one's a little bit different. We've got, the 000, 660, KS, and then down here with a Sustec computer, similar thing. Can you just explain kind of what the differences are here?
Yeah, these are international ordinary securities. So we're not buying ADRs, meaning foreign companies that list on exchanges here. We're buying US companies and companies domiciled in their home countries. So SK Hynix is South Korea, Sustec, I believe, is Australia. So, we're buying the actual ordinary securities.
Yeah, and here's where, if people want to see, SK Hynix right here, this is up 50% year to date. It's just continuing to move. And really, I think you guys caught that perfect timing with when you came out with this and added it in, because if I am correct, the launch date of this was December 3rd.
Correct.
And if we look at SK Hynix, we kind of had I believe a really nice move from there back in December. Yeah, exactly. So, I mean, wow, look at that.
Yeah, not bad.
Kind of catching the bottom, because this was one of the first names in here, right?
Oh yeah. It's been with us since day one. Not as our top holding. I think it's always been in the top 10 though since we launched.
Yeah. So this has done great, and so it's just showing, like, I just don't think a lot of retail would necessarily have thought of a name like that when it comes to these different pieces, and when it comes to AI, right? And when they go look at it, this is a South Korean supplier of dynamic random access memory chips and flash memory chips, right? It's one of the world's largest semiconductor vendors, but I just don't think most people would have guessed that.
No, I certainly would have. I wouldn't have. I mean, it's a name that you don't know, but that's the point again, right? So again, you can go out and buy an AI fund that has Meta and Amazon and Netflix and Tencent and these other names that you already own another product, I'm sorry, go on.
No. Sorry. I apologize. Please.
No, I was going to say, or you can get something of companies, again, that you don't own to further diversify your portfolio. A, B, actually get companies that are the ones benefiting from these hundreds of billions of dollars in CapEx spend. I mean, again, Meta is spending $100 billion where the money is going is into companies like these, because these are the ones that are building the data centers and the semiconductors. So these are the companies that are actually making money. These are where the profit pools are. right now.
Yeah.
5 years from now, 8 years from now, it might shift to a Meta. And at that point, then we have the ability to bring those types of companies in the portfolio, but we're not going to do that until that's, at least 30% of their profits.
Evan, would you have guessed MU? Have you looked at that chart recently?
Not particularly.
Would you have guessed that they're up 100% in the last 2.5 months?
Not surprised. That's how stocks like this move. Very cyclical. And you say that, but like $120, I feel like it's been in this price like multiple times. Maybe it hasn't been that many times. I don't know. I'm not super surprised on Micron. That's how it's kind of moves.
Yeah, really interesting one here. And obviously, I mean, if you guys have been holding it since December, kind of had that ride down, but now back up into this area. And this is just a crazy chart that I've been looking at. I mean, what is that? One red day in basically this month. I think it said one red day in June.
That's wild. That's wild.
So
It's
pretty nuts to see.
great company. But that's because the narrative is back, right? I mean, or at least investor sentiment is back. The narrative, the fundamentals in AI, the AI opportunity has never changed. It just went out of favor for a few months.
Yeah.
So I think everyone's back on board and sees what's going on.
Yeah, TSM almost back at all-time highs as well. They have a real case. I mean, TSM is going to continue to grow. So there you go. AIS, for those that want to go take a look at it, it seems just like one of the most pure AI picks and shovels plays, ETFs right now. Plus, you get experts that will go in. And it's not like you guys are making a million trades inside of here, but just, even if it's once a quarter, just adding, subtracting pieces here and there, fine-tuning it, you really do have really high-quality people creating this for you.
Yeah, our investment committee, and that's to your point, that's our secret sauce, right? It's our bill of materials process in developing the core portfolio that is fully transparent. We provide that methodology guide to anyone who wants to see it. But it's the investment committee made up of John and Sonny, myself, and Professor Robert Whitelaw, former dean of NYU Stern School of Business. John and Sonny live this every day. Sonny's building data centers all over the world. His company Grok is a core piece of that whole initiative down in Saudi Arabia. I think it's called Humane, where they're building out all this inference technology or capabilities. So, they know the companies. They know all these companies, and they know who's doing well, who's not doing well, whose technology is strong, who's not. And that's their job with this product, is to identify those risks and opportunities, hopefully early.
For sure. Yeah, it's just super interesting names. I encourage everybody to jump in there and just take a deeper look. Evan, do you have any thoughts or questions here on AIS?
I think the AI theme is really strong. And kind of like I was talking earlier, with CME Group. Hey, we're all playing what model's slightly better and, what we're going in the direction. But there's a lot of companies underpinning it right now. And that seems to be a slightly better area to, at least, like I said, if this is a really big theme, like people believe it, we're probably in inning number one. And that seems like more of the viable play for this inning number one, and let some of the winners play itself out. So, yeah, no, I like the theme of AI, and I like the theme of what's underpinning it, as opposed to just, hey, NVIDIA is underpinning it, but hey, just NVIDIA and just whatever. And just like OpenAI.
Yep.
So, yeah.
Yep.
I've been seeing a lot of posts, especially just going back for TSM for a second. It's just like the perfect fit in there, because I don't think people realize, is it TSM is creating like 100% of the silicon chips for NVIDIA and a couple other people right now? There were some wild stats I was seeing. Did you guys see this?
Yeah. I mean, a massive market share. I don't know if it's 100 or not.
It's crazy.
Massive. Yeah, I mean, it's a powerhouse company. It's incredible. And look at AMD, another one, right? AMD is another one that people have been avoiding, and now they're kind of their judo strategy on their technology, right? Going after the inference area instead of playing right up against NVIDIA. So, and you need exposure to these companies, and that's what we're trying to provide.
Yeah, let me pull up as well one last piece here. This is something that you sent me a little bit earlier today that I wanted to share with the audience. All right, let me just see if I could get this window. Here we go. All right, you able to see this?
Yep.
Cool. So can you walk people through the supply chain analysis here?
Yeah, I mean, this is kind of a high level of how we design this product. So this is a high level supply chain analysis for the semiconductor piece. And on the next page is the data center piece. So what we do on the left-hand side, the first thing we do is we map out the different categories. So, just pick one of them. Yeah. So this is semiconductors. So we'll map out all the different major categories of what goes into building a semiconductor, an AI semiconductor. Then when we have that, then we overlay the bill of materials to determine how much does that cost within that, the build process. So if you look at data centers right here, you'll see power and cooling is actually around 30% of the overall price of the build of an AI data center, which is incredible, right? Who would think that, right? So 30% is huge. It's a massive piece of the puzzle. So, okay, we know that now. So then who are the companies? Then we map the major suppliers to that. Then what we do is once we determine who the major suppliers of cooling systems are, that's when the real work starts, where we start analyzing. Are these companies in the cooling business, in the data center cooling business, or in the AI data center cooling business? So we have to determine that first. Then once we get rid of all the companies that aren't doing specific AI data center projects, then we have to look at their financials. And we want to see that they are actual major players in that space. Not, they got a deal, they're a subcontractor. And, we want to make sure there's at least 30% of the revenues coming from direct AI deals or pipeline. And that's how we build the portfolio. And then we roll it into the core portfolio. So it's this bill of materials process. And look, there's other institutional investors that do things like this. Big hedge funds might have analysts doing this type of research, but nobody's doing this in the fund space. It's just too much work. But we built our team to enable us to do this because we think it's the right way to get exposure to not only AI, but other what we call super cycles that will be bringing out additional products around those as we move forward.
Has the team been expanding?
Yeah, we keep adding people both on, all over the company. So, a lot on the infrastructure side now, or the analytics side, to help us with all this work that needs to get done.
Was John McDevitt there from the start? I noticed that he's on the website.
Yeah, he's our CCO.
Perfect.
Yeah, we've got all the infrastructure, a lot of infrastructure, because we're not in this to build a small company. We're in this to build a leading company in the space. So, we put the money into it to make sure we can do that.
Absolutely. Very strong panel. Okay, awesome. We've got one more that I want to make sure we touch on here before we wrap up, and that's going to be Wild, which has been going wild, especially since our last conversation. So we talked on the day that Wild launched, or was it one day afterwards? Something like that, right?
Yeah.
And it was it was down 10%.
Yeah.
The first day, just because, Wild. So I guess we should just explain this real quick. Yeah. Wild to me is pretty fascinating. And especially because our audience is very, very in tune with double leverage ETFs, right? Everyone already knows about them, TSLT, right? TSLL, all these different ones. And same thing for, other double leverage stocks that are out there. You've got NVIDIA, so on and so forth. Wild takes a look at across the board, all of the double leveraged ETFs, and it says, okay, let's take a look at who has the most AUM if you add it up in total, and who's grown the most in AUM since the past month, right? Correct?
Yes.
Yeah, there we go. So the two items, and then you plot that, you dot plot it all out on a chart, and you say, okay, we're going to look, only ones that have grown a certain amount are qualified to be inside of it this month. And we're going to now look from all those who has the most AUM in the top 5. We're going to equal split this. So, and then it's double leveraged, right? So every dollar that I put in, I get 40 cents exposure to each one of those items, and it can move with quite a high beta. With that being said, for those that, are looking at the chart, Wild, W-I-L-D, we talked about it again, down 9.81%. That first day pretty much, or second day when we were talking about it, it came all the way back from there. And on June 11th, even June 16th recently, this was up 4.3%. So when we were talking about it, it was trading at 17.83, and then it went all the way to $20.62. And now it is basically perfectly flat since it launched. I believe earlier today it was slightly green over that 20 mark, now trading at 1974. So this thing has just been all over the place. And we talked about this as a trading tool. So walk us through a little bit more of just, latest insights. Are you looking and expecting changes to be made to this next month in regards to the names that are in there? This to me is just a pretty fascinating one.
Yeah. So as you mentioned, it's 5 stocks, rotated monthly, leveraged up 2x, and we reset the leverage daily. So, we're trying to, and this is an institutional strategy. This is a pure institutional strategy that we've designed and packaged as an ETF. So institutions are not picking single stocks. saying I really like Tesla. I mean, they might be, but as a whole, they're not doing that. They're not saying I like Tesla. Let's go buy a single stock leverage ETF. They don't want that single stock risk. They want the high beta exposure. So what they do is, we're packaging 5 of the hottest companies in the space every month based on investor sentiment. We go where the money's going, to your point, the names that are attracting the most money and have the most assets. Very simple. So, we've got Meta, we've got Palantir, Supermicro, MicroStrategy, and Tesla as the first 5. We equal weight those, and every day we reset them back to equal weight. So it's a great way for an investor to get access to that kind of trading exposure. And it's still going to be very volatile, but it may not be as volatile as, picking Tesla on the wrong day or Nvidia on the wrong day. So that's what we're trying to help investors avoid. And, every month we're going to switch those stocks around based on where the money's going. The animal spirits of the market, right? The investor enthusiasm. It's all about behavioral finance. And this is how investors or institutional investors are gaining access to this. So, we're really excited about this product. The markets have not been ideal for, seeing the true upside of a product like this, but what you are seeing is, the volatility, how you can, you could get in and out of it and make money.
Yeah, 100%. I'll share one thing on the website about this, then we'll move into some final comments here. If people go to the wild, you were pointing something out to me. It was the investment case.
Yeah, if you go to the top.
Yeah.
Yeah, you click on investment case.
There it is.
Hopefully it works.
Oh, yeah, perfect. Yeah, so this is great. So this is kind of what I was referring to. So people can see, growth in monthly inflows. You have to obviously be positive. Then total asset base, adding up all of them. Tesla, MicroStrategy, Palantir, Meta, and Supermicro right now. There was mention of some that didn't make it right because Nvidia, they had negative monthly growth from inflows the past month, so they couldn't make it. Coinbase as well, even though they had sizable, right? So that's why this one really is that kind of outliner out, and this one as well. And then you kind of have some unique ones up here, which maybe they'll start growing. I'd be very curious to know what these two are right here. So I know that was something I chatted with you about that I'd be curious to see. But yeah, any comments on this investment case?
Yeah, no, I mean, I think that we try to make it as easy to understand as possible. One thing to note, which I just want to make extremely clear, we do not invest in double leverage ETFs. We don't buy those ETFs. Right. What we're doing is we're using them as data for their flows. And this is right.
And then how are you obtaining your leverage?
Through swaps. So it's a total return swap and it's reset daily.
Perfect.
And just like the single leverage, they're doing the same thing. They're using total return swap. So mechanically, it's the same type of process. It's just 5 companies instead of 1.
Got it. Evan, do you have any comments here on Wild?
Yeah, I'm curious on the rebalancing aspect of it. With the 5 names in there, how that kind of is going to end up looking like. Yeah, and I'm also curious just like what benefits there are in doing the strategy with 5 names versus 1, or even just 1 versus 2, or multiple names versus 1. I'm curious on how that was back tested out and thought about.
Well, I think with 1, I mean, look, if you love Tesla and you're sure you're going to make a bet and it's going to go up, buy it, right? For sure. It's hard betting on a single stock or a single name, particularly when it's double leverage, because if you get it on the wrong day, you're going to get your face ripped off. So, I mean, it's just a riskier play, not a bad play. And for some investors, it's going to be a great way to, express their views of the market. But I think for most investors, what they're really trying to get at is that high beta exposure. They want to get some alpha in their portfolio. So, do they have high conviction on Tesla? Maybe, maybe not. But why not take a more kind of a broader approach that avoids that single stock risk, but still gives you exposure to 5 of the quote hottest names in the market, and hot meaning what other investors are betting on. So you don't have to choose one. You can go with what the investors are betting on with their cash. And then look, if you still love Tesla, you can still buy Tesla and overweight it on its own, but you already have exposure in this core portfolio.
Exactly. Yeah, very well put. We are going to wrap up here. We're almost at the top of the hour. Adam, this was a lot of fun. We ran through a bunch of stuff here. Anything else you'd want to share with the audience?
No, I appreciate your time and the time of all your listeners. Take a look at our website. We've got some good research on there. We're constantly adding content, kind of educational content, whether it's around tax treatment of income strategies or how income strategies are constructed, or we have every other week we put up an AI digest, so we do stuff like that to keep people informed. Give me a follow on X. I try to always put up some content up there as well, and I just appreciate your support.
Yeah, absolutely, everybody. It is right here. You can find it at Adam Patty. Make sure that you are following as well. Get them 2,000 followers coming up fast.
Nice.
Evan, anything else for you on this one?
No, I appreciate everyone. It was even though we had one less day, it was still kind of felt like a little bit of a long week. But here we're in the summertime. I feel like people go a little bit more on vacations, hang out a little bit. So maybe it takes some more time to look into products like these and other stuff and enjoy your summer, dig deep into stuff. And I hope everyone has a great weekend. I appreciate you. Obviously, follow Adam, follow the Wolf Count anywhere you're watching, and I appreciate everyone. Check out the ETFs.
Yeah, make sure that you're taking a look at them. We enjoy working together with Vista Shares. The ETFs that we're working together with and that we mentioned in today's call are AIS, OMAH, QUSA, and Wild. And that's going to pretty much do it for this one. Thank you to the 8,600 people who tuned in. We'll look forward to seeing you on the next one. Take care.